All right, welcome to The Explainer. Today, we are cracking the code on one of the most important and honestly, one of the most misunderstood concepts in all of finance, carried interest. Stick with me because by the end of this, you're going to understand exactly how it works and, way more importantly, what it means for you as an investor.
So let's just jump right in with a question. What do you think is the riskiest part of a private equity manager's paycheck? Now, it's probably not what you're thinking. It's not some guaranteed massive bonus. The real answer is actually a lot more interesting, and it's something you absolutely need to understand if you're looking at private markets.
You know, in today's world, more and more people are getting access to these kinds of investments. And that's exactly why knowing the difference between real money and what's just a promise on paper, well, it's everything. It is the key to being a smart investor.
All right, first up, the private equity puzzle. Let's start putting the pieces together on what this whole carry thing is really about.
Okay, so what is carried interest really? Let's get right to the heart of it.
Okay, at its most basic level, carried interest, or carry as you'll hear it called, is basically a performance fee. It's the slice of the profit that the fund manager, the general partner, or GP, gets to keep. But, and this is the really important part, they only get that slice after the investors, the limited partners, or LPs, get all their money back, plus a bonus return on top. So this is no guaranteed paycheck. It is 100% tied to how well they perform.
People in the industry call this flow of money the distribution waterfall, and it's a great way to picture it. So think about it like this. Step 1, investors put their capital into the fund. Step 2, the manager goes out and invests that money into companies. Then, step 3, a company gets sold and hopefully there's a nice profit. But now here's the crucial part. Step 4, the water flows to the investors first. They get all their initial cash back, plus that preferred return we mentioned. It's often called a hurdle, and it's usually around 8%. Only after that hurdle is cleared does the manager finally get their share of what's left.
So what's the magic number? Well, the standard share that managers get is 20%. That's kind of the baseline. Now, if you're talking about the absolute best of the best, the top performing funds in the world, yeah, you might see that number creep up to 25, maybe even 30%. It's the ultimate reward for knocking it out of the park for your investors.
Okay, now we're getting to the really interesting part, real versus paper profits. Look, knowing the definition is one thing, but the real secret, the thing that separates smart investors, is understanding the massive difference between actual cash in the bank and profits that, for now, only exist on a spreadsheet. And right here, this is the multi-million-dollar secret. This is what the pros really dig into. A firm can go out and say, hey, we've got $1 billion in carry, but that number can be seriously misleading because, and this is the main takeaway today, not all carry is created equal.
This really gets to the heart of it. You've got two fundamentally different kinds of carry. On one side, you have realized carry. Think of this as cold, hard cash in the bank. It's profit from deals that are done, dusted, sold. It's locked in. On the other side, you have unrealized carry. This is just an estimate on paper. It's what a firm thinks they'll make from investments they haven't sold yet. Here's the best analogy I've ever heard for it. Unrealized carry is like that online estimate of what your house is worth. Realized carry is the actual check you get after the closing. One is real, the other is just a guess.
And man, that distinction is so important. Just look at this breakdown for a typical firm. That little slice, the 20%, that's the real stuff, the realized carry. But look at the rest of that pie. A huge chunk is unrealized, based on mature companies. And an even bigger slice is just, well, it's speculative. It's future hope. So when a firm talks about its carry, remember that a massive portion of it is really just a bet that things will go well down the road.
Okay, so just when you think you've got this all figured out, here comes another twist. You hear realized, and you think, okay, the deal is done, they paid their taxes, right? Well, surprisingly, the answer is often no. This is another one of those little details where the jargon can really trip you up.
So, from an accountant's perspective, realized just means the deal has closed and they've done the math, the manager is officially entitled to their share of the profit. But, and it's a big but, the actual cash could still be sitting in escrow or maybe it's being held back for a bit just in case. So the entitlement exists on paper, but the money hasn't actually hit their bank account.
But you know who has a very different view? The IRS. They don't really care about when you're entitled to the money. For them, carry only becomes taxable income when the manager actually gets the cash in their hands or has total unrestricted access to it. That's when the tax clock starts ticking. Not when the profit is calculated on a spreadsheet, but when the money actually moves.
Okay, new section. Investing in the managers. So, you might be thinking, this is all interesting, but why does it matter to me? Well, here's why. It's because these days you can actually invest in the management company itself. It's called a GP stake. And when you do that, you are literally buying a piece of their future carried interest stream.
And when you buy a GP stake, you're not just buying one thing. You're buying into the firm's whole economic engine. You get a piece of their steady, predictable management fees. You get a piece of the investments they make with their own money. And of course, you get a slice of that variable, but potentially massive carried interest. It's this really cool blend of stability and high-performance potential.
And this table really breaks down how the pros think about the risk here. Look, if a firm has a ton of realized carry, what does that signal? It means they have a proven track record of actually selling companies and making cash. That's a lower risk profile. But if a firm's profile is mostly unrealized or future carry, well, the pipeline might look promising, but you're making a much bigger bet on their ability to deliver down the line. It's a higher risk.
All right, last section, your investor checklist. Let's make this super practical. How can you use all this? I'm going to give you the exact questions you need to ask to pull back the curtain and really see what you're buying into.
Okay, get your notepad out. This is your checklist. First and foremost, what is the percentage of realized versus unrealized carry? Is it 20% real or 80% real? Next, how diversified is that income stream? Is it spread across a bunch of different funds and vintages, or is the whole firm betting the farm on one or two big future exits? Then you got to ask, how conservative are the valuations they're putting on their unrealized deals? And finally, the ultimate proof. Over the last, say, 10 years, what percentage of their on-paper value did they actually turn into cash? These are the questions that let you see past the fancy brand name and get to the true quality of the operation.
You know, it all boils down to this single idea. The more carry that is realized and crystallized, the lower the underwriting risk. The more carry that is unrealized, the more you are betting on the future. It's as simple as that. One is history, the other is a story.
So, I'll leave you with this. The next time you're looking at an investment in this space, just stop and ask yourself this one simple question. Am I buying a proven track record of generating real cash, or am I just buying a really, really hopeful projection? The answer to that question, well, it's going to tell you everything you need to know.